are equity markets just almost getting any excuse to rally? And what does that mean on how they're perceiving risk?
I guess that you need to understand what is driving the equity market. So everyone is talking about the bear market rally and the fact that it's not sustainable. But when you look at, especially on the U.S. equity market, what drove the rally, it's been mostly defensive stocks, tech stocks, healthcare. So basically investors looking for bond proxy rather than anticipating already some kind of economic recovery. So I guess that we're really non-consensual and we're less negative on the U.S. equity market than others on the street.
But is there worry that we'll have a correction, Sophie, if there's a second lockdown? And again, as a global asset allocation strategist, I don't know what kind of metric you look at to understand those dynamics.
So it's true. So for me, in terms of assessment of risk at the moment, it's clear that a second lockdown is not in the prices. It's clear that like an L-shaped recovery is not in the prices. But I guess that we're more in the middle, where in terms of earnings expectation, markets are at this point pricing between a soft and intermediate lockdown, so much less than what we got in Wuhan, so 2.5 months of lockdown. For now, the equity market, if you look at it, the fact that it's been mostly driven by bond proxy, it's been much more investors trying to gear to the low interest rate environment. So if we have a second wave of lockdown, yes, the equity market can go down, but mostly driven by this defensive tech healthcare stock that benefits from a second lockdown. So I think limited downside from here.
What do you do with some of the other asset classes? I mean, a couple of people saying, actually, in this environment, maybe we should also look at cash. What do you look at cash? What do you look at gold?
If you look at what happened during the meltdown on global markets in March and early March and end of Feb, it's clear that Treasuries and gold were a bit put into this turbulence, and they weren't that protective as we would have thought, especially gold. But it's clear that if we're more on the side of a bearish scenario, so another second wave of lockdown, and the fact that the recession is going to last much longer, then yeah, gold and treasuries continue to be safe haven. But treasuries, I would start to be slightly more cautious as long as the Fed doesn't signal that they will go lower than the zero lower bound. So limited portfolio protection at this point.
Sophie, we were speaking to one of the head of fixed income for the BlackRock Investment Institute, and actually after a conversation, he just said, look, whatever you do, don't fight the Fed. Is this a 2020 motto?
Don't fight the Fed, but I think at some point in 2021, the question investors will like to focus on will be, is there a price tag for this historical budget deficit? Because if the economic actually recovers and we have any other recovery shape than an L, so it could be V, W, or swoosh, the next question for me is gonna be about quantitative tightening. The fact that we're going to have to pay at some point for this historical budget deficit. So what's going to be the impact on asset classes? And I'm sure at this point it's not going to be a long sovereign bond.
Very quickly, Sophie, what do you do with the inflation versus deflation debate? And does that change your appetite, for example, for gold?
I guess that it depends on the time frame you're looking at. So in the short term, everyone is talking about deflation because of the recession fears we have at the moment. But it's clear that the debate on a localization towards more globalization and change of supply chains, the fact that oil price is recovering with some kind of base effect, the fact that break-evens didn't go to the levels we've seen in 2008 is really showing that investors are not that complacent about inflation expectation as they could have been during previous recession.